Something important is unfolding in the silver market right now, and most people are looking in the wrong place. On the surface, it looks familiar. Sudden drops, sharp candles, heavy volume. Commentators saying silver is weak or the rally failed again. But if you slow down and really study what's happening, a different picture starts to emerge. This isn't random selling. This isn't fear-driven liquidation. This is controlled pressure. Banks are dumping paper silver, not because they want lower prices forever, but because they need time. Time to reposition. Time to manage exposure. Time to prevent something from accelerating too fast. And that distinction matters. Paper silver is not physical silver. It's a promise, a contract, representation of metal, not the metal itself. These contracts can be created, sold, and rolled in volumes that would be impossible in the physical world. That flexibility is precisely why paper markets exist. They smooth volatility. They provide liquidity. And, when necessary, they suppress price discovery. When banks dump paper silver aggressively, it creates the illusion of excess supply. Price reacts downward. Sentiment turns negative. Momentum traders exit. Longs get shaken out. To most observers, it looks like silver simply failed again. But the key question is not what price did. It's why the selling happened when it did. Banks don't act emotionally. They act strategically. They don't dump paper silver because they suddenly believe silver has no future. They dump it when allowing price to rise freely would create problems they aren't ready to deal with yet. Think about that for a moment. If silver were truly irrelevant, if supply were truly abundant, if demand were collapsing, there would be no urgency to cap price. Markets would do the work on their own. There would be no need for concentrated selling at specific levels, during specific windows, around specific events. Yet what we're seeing is precision, sharp moves into thin liquidity, selling waves timed around technical breakpoints. Pressure applied just as sentiment begins to shift bullish. That's not coincidence. That's defense. Paper silver dumping is often a delaying tactic. It's used when the underlying structure is becoming uncomfortable, not broken yet, but strained. It buys time by pushing price lower while the system adjusts behind the scenes. And this is where many people misunderstand what's happening. They assume lower price means lower risk. But in markets like silver, lower paper prices can actually increase systemic risk. Why? Because physical demand doesn't always respond the way paper traders expect. When price drops sharply due to paper selling, physical buyers don't panic. They step in. Industrial users, long-term holders, and institutions that care about access rather than speculation view those dips as opportunities. They don't trade minute by minute. A tease secures supply. That creates a problem, because every ounce quietly absorbed during these paper-driven sell-offs is an ounce that is no longer available to satisfy future demand. The paper market can expand almost infinitely. The physical market cannot. This is the tension at the heart of silver. Banks can dump contracts, but they cannot dump metal they don't have. As long as most participants are content settling in cash, the system holds together. But the moment more participants want certainty, actual delivery, actual access, the balance shifts. That shift doesn't happen all at once. It builds. Right now, we appear to be in a phase where price is being leaned on, not because silver is weak, but because allowing it to rise would reveal stress before the system is ready to handle it. This is why the selling often feels aggressive but short-lived. Price drops hard, then stabilizes. Follow-through is limited. The market doesn't collapse, it hesitates. That hesitation is telling. It suggests that while paper pressure is heavy, underlying demand is absorbing it. Historically, this pattern shows up in the later stages of compression. The market is no longer free to move higher, but it's also resistant to sustained declines. That creates frustration. People lose interest. They say silver is dead money. And that's exactly the environment where structural shifts continue unnoticed. Banks understand psychology extremely well. They know that confidence is as important as liquidity. If participants stop believing silver can move, positioning lightens. Risk feels lower. That makes future adjustments easier to manage, at least temporarily. But delaying tactics have limits. Dumping paper silver does not eliminate demand. It does not create new supply. It simply postpones reconciliation between price and reality. And the longer that reconciliation is delayed, the more abrupt it tends to be when it finally arrives. Right now, what matters is not the daily candle, it's the behavior around it. The repeated need to apply pressure. The urgency to prevent follow-through. The reluctance to let silver trade freely. Those are not signs of control. They are signs of concern. Because if everything were truly fine, nothing would need to be delayed. And if banks are delaying what's coming, the obvious question becomes, what exactly are they buying time for? Most people don't realize this, but when banks dump paper silver, they're not selling something they actually own. They're selling a promise, a contract, a claim, a shadow of silver. And here's the uncomfortable truth. There is far more paper silver in circulation than there is real physical metal on this planet. Think about that for a second. If everyone who owns silver on paper showed up tomorrow and asked for delivery, the system would collapse instantly, not slowly. Instantly. That's the fragility hiding behind those calm price charts. And this is why what's happening right now matters so much. Banks don't dump paper silver when they're confident. They dump it when they're under pressure, when inventories tighten, when industrial demand keeps climbing, when physical silver starts quietly disappearing from vaults while the public is distracted by headlines, politics, and short-term market noise. This is not random selling. This is defensive behavior. Silver is not just a monetary metal. It's not just an investment. It's a critical industrial resource. It's used in solar panels, electric vehicles, medical devices, defense systems, and advanced electronics. Unlike gold, most silver is consumed. It's used once, and then it's gone. So while paper markets can create infinite supply with a keystroke, physical silver cannot be printed. And that's where the danger begins, because every time banks push the price down with paper, they make physical silver cheaper for industrial buyers, sovereign buyers, and long-term accumulators. They accelerate the drain on real supply. They are digging the hole deeper. This is the paradox they're trapped in. They suppress the price to maintain control, but the suppression itself creates the conditions for a violent reset later. And here's the part most people miss. Silver doesn't move like gold. Gold is slow, controlled, managed. Central banks hold it. Governments respect it. Silver's messy, volatile, emotional. When it breaks, it doesn't politely rise. It explodes. Historically, silver stays quiet for long periods. It frustrates investors. It makes people give up. And then, without warning, it reprices in weeks what should have taken years. That's why banks fear it. That's why they attack it. That's why they use paper dumping instead of letting the market discover the real price. Right now, we're seeing signs that physical silver is no longer responding to paper suppression the way it used to. Premiums are staying elevated. Delivery times are stretching. Vault inventories are being questioned. Even large institutions are starting to ask uncomfortable questions about counterparty risk. And when confidence cracks in a paper-based system, price becomes irrelevant. Because at that point, it's not about what silver costs. It's about whether you can get it at all. Ask yourself something honestly. Why would banks need to dump paper silver aggressively if nothing was wrong? If supply was abundant? If demand was fading? If the system was stable, they wouldn't. This is not strength. This is containment. They're trying to delay what's coming, not stop it. And delays always make the outcome worse. What we're watching is a pressure cooker. Every paper dump adds more steam. Every suppressed rally adds more tension. Every drained ounce tightens the system further. And when it finally breaks, it won't announce itself politely. There won't be a warning banner. There won't be time to react. Silver doesn't give second chances. By the time the headlines catch up, the move is already over. That's why the most dangerous moment in the silver market is not when prices are rising. It's when nothing seems to be happening. But the banks are quietly panicking behind the scenes. And right now, they're panicking. Here's the final piece of the puzzle, and this is where things get uncomfortable for the system. Paper silver only works as long as people believe it represents real metal. That belief is everything. The moment confidence breaks, even slightly, the entire structure becomes unstable. Not because of prices, but because of trust. And trust is fragile. For decades, the silver market has relied on one assumption: that most participants will never ask for delivery, that they'll trade contracts, not metal, that they'll settle in cash, not ounces, that they'll play the game and never test the system. But something has changed. More people are no longer asking what's the price of silver. They're asking, where is the silver? That shift is subtle, but it's dangerous. Because systems don't collapse when prices rise. They collapse when belief disappears. Banks know this. Exchanges know this. That's why paper dumping intensifies whenever physical demand becomes visible. It's not about profit, it's about perception. Keeping silver looking boring. Keeping it looking weak. Keeping people disinterested. Boredom is the greatest weapon against silver. As long as silver feels frustrating, slow, and disappointing, most people walk away. They sell. They stop paying attention. And that gives the system breathing room. But boredom doesn't last forever. There comes a point where suppression no longer creates apathy, creates suspicion. And once suspicion spreads, behavior changes. People stop trading contracts. They start taking delivery. They stop trusting promises. They start demanding proof. They stop asking how much. And start asking how many are left. That's when the game changes. Because paper markets can survive volatility, they cannot survive delivery pressure. You don't need everyone to ask for metal. You don't even need most people. You only need a small percentage to demand what they were promised, and that's the nightmare scenario. That's why banks dump paper silver aggressively during quiet periods. They want to exhaust interest before that tipping point arrives. They want to break morale. They want to convince you that silver is dead money. But here's the irony. Every major silver move in history was preceded by boredom, frustration, and disbelief. Every single one. Before silver explodes, it always feels pointless to hold. And that's where we are now. The disconnect between physical reality and paper pricing has never been wider. Industrial demand is not slowing. Green energy demand is accelerating. Monetary distrust is growing. Debt levels are unsustainable. Currencies are being diluted. Confidence is thinning. Yet silver just sits there. That's not normal. That's pressure. And pressure doesn't disappear. It transfers. At some point, banks won't be able to dump paper fast enough to cap the price without exposing themselves. At some point, the cost of suppression becomes greater than the cost of repricing. And when that moment comes, the move will not be gentle. It won't be orderly. It won't wait for retail investors to get ready. Silver doesn't climb a staircase. It launches like a spring that's been compressed too long. That's why the most dangerous thing you can do in this market is assume you'll have time later. Later is what everyone says right before the reset. This isn't about predicting a date. It's not about hype. It's about understanding structure. Paper silver is a leverage system sitting on top of a finite resource. The more that leverage expands, the more violent the eventual correction becomes. And here's the question no one can answer honestly. What happens when paper silver loses credibility overnight? Do prices adjust slowly, or does the market gap violently to wherever physical supply actually clears? History already answered that. When confidence breaks, markets don't negotiate, they reprice. And when silver reprices, it doesn't ask permission. So if you're watching this and wondering why banks are dumping paper silver right now, understand this: clearly it's not because silver is weak. It's because silver is dangerous. Dangerous to a system built on leverage, promises, and infinite paper. Dangerous to institutions that need stability, predictability, and control. And dangerous to anyone who assumes the game can go on forever. The quiet you're seeing right now is not calm. It's restraint. And restraint never lasts, because eventually reality forces its way through paper. And when it does, the people who understood what was happening during the silence won't be chasing price. They'll already be positioned, not because they guessed, but because they listened when nothing was happening. And that's when silver is at its most honest.